past papers. That is from 2017. That is from May 2017. Question number 3. It's about a company called 𝘬𝘪𝘵 Limited. May 2017. Question number 3. May 2017. Question number 3. The question reads, May 2017, question 3. The question reads, 𝘬𝘪𝘵 Limited is an electronics company which has been listed on the Securities Exchange for the last 2 years. Provided below are the equity and long-term funds of the company as at 30th April 2016. Also provided are the income statements and the statements of movements in reserves for the year ended 30th April 2016 and 30th April 2017 respectively. Then you are told in the additional information number 1 that on 1st November 2016, the company made a bonus issue of shares on the basis of 1 ordinary share for every 6 ordinary shares held. Number 2, on 1st March 2017, the company made a rights issue of ordinary shares for every 7 ordinary shares held. The rights issue price was 8.5 per share, and the market value of the ordinary shares on this date of the rights issue was sh12.5 per share. Number 3, the 8% convertible loan stock can be converted at the option of the holders from the year 2022 at the rate of 125 ordinary shares for every 1,000 shillings of the loan stock held. Number 4, the corporate tax rate is 30%. Number next, there was no issue of preference share capital in the year 2017. Number next, there was no issue of loan stock in the year 2017. You are required to compute the basic EPS for 2016 and for 2017, the comparative EPS and the diluted earnings per share. So we are going to start with computing the basic EPS for the year ended 30th April 2016. So we are going to start with the basic EPS for the year ending April 2016. So we know that basic EPS is given by ethos, earnings attributable to ordinary shareholders, divided by weighted average number of ordinary shares. We are calling it WANOS. As far as ethos is concerned, we know that ethos for 2016, we know that the company made a profit for the year of 31.85 from the income statement. 31.85. But at the same time, the company paid preference dividends of 30. That is, sorry, for 2016, it was 36.30. But we know it paid preference dividends of 30. And therefore, our ethos will be 3,600. That is our ethos. When it comes to WANOS, we know that the value of our ordinary share capital is 19,200, and each share across that has a par value of 8 shillings, and therefore we can comfortably say that our WANOS will be 19,200 divided by 8. So once I use my calculator, 19,200 divided by 8 comes to 2,400. It comes to 2,400 ordinary shares. And therefore, our basic EPS for 2016 will be 3,600 divided by 2,400, Once I use my calculator to do that, I'm getting shillings 1.5 per share. I'm getting shillings 1.5 per ordinary share. Then we get to 2017, EPS for 2017. We know that ETOS will be the profit for the year, which I can see that it is 31.85 minus preference dividends of 30. This comfortably gives me 31.55. That is the ETOS for 2017. Now, what is remaining is now to get the WANOS for 2017. The WANOS for 2017, you need to prepare what we call a share movement schedule to get the WANOS of 2017. So let's do a share movement schedule. Let's do a share movement schedule. It is prepared in this format. You write date, details, number of ordinary shares, time factor, and then finally the weighted average number of ordinary shares. We always start by bringing down the balance on 1st of May 2016. Because that was the first date of the year, we bring down the balance of ordinary shares. We know that we had 2,400 ordinary shares. And since these are the ordinary shares at the beginning, these shares were there for the whole year. And therefore, the time factor is 12/12, or rather 1. And therefore, the WANOS, as far as the balance brought down is concerned, will still be 2,400. Then from there we have note 1 first. Note 1. On 1st November 2016, the company made a bonus issue of shares on the basis of 1 ordinary share for every 6 ordinary shares. So this was done on 1st November 2016. It was a bonus issue. A bonus issue of 1 for every 6. 1/6 times 2,400 gives me 400. And since bonus shares are not weighted, you put a dash. And therefore, the WANOS for the same will still be 400. Then we get to note number 2. On 1st March 2017, the company made a right issue. 1st March 2017, a rights issue was made. And the ratio for the rights issue was 1 for every 7. So 1/7 times the total number of outstanding shares at that date, which will be the brought down plus the bonus. That is 1/7 times the totals of these two. This is 1/7 times 2,800. This comfortably gives me 1/7 of 2,800 to be 400. Now, once you get the number of shares arising from the right issue, you split it into 2. You split it into 2 components. That is the fully paid element, which will be weighted on time basis, and the bonus element, which should not be weighted on time basis. Therefore, we need to do that split. To do the split, you take the number of shares, which is 400, times the right issue price, which is 8.5, divide by the full market price, which is 12.5. So once I use my calculator to do that, 400 times 8.5 divided by 12.5, it gives me 272 shares. These are the shares which are deemed to be fully paid, and they should be weighted on time basis. And considering that this was done on 1st of March 2017, up to the end of the year, which is 30th April 2017, that should be 2 months only. That is the month of March and the month of April. Therefore, these shares should be weighted on the basis of 2/12. So, once I multiply 272 by 2 divided by 12, I'm getting 45.3333 recurring. Now, there is the other aspect of bonus element from the right issue. We know the total number of shares issued through the rights is 400, and now we know that the ones which are deemed to be fully paid for are 272, and therefore the ones which are deemed to be issued for free, or rather bonus shares, you take 400 minus 272. This gives me 128 ordinary shares. These are bonus shares and they should not be weighted on time basis, so I put a dash. Therefore, my weighted average number of ordinary shares will still be 128. 128. I continue with my question. Number 3 is about 8% convertible loan stock, which was never converted. There is no information to the effect that the loan stock was converted. The other one is about the corporate tax rate, and the other one is just a confirmation that there was no issue of preference shares and no issue of loan stock. So once I get my one-offs, I sum up these figures to get my one-offs. So I'll be having 128 plus 45.3 plus 400 plus 2400, which was the balance brought down. I'm getting 2973.3. That is my denominator, or rather the one-offs. And therefore, to get my basic EPS, I will take my ethos, which was 3155. I divide by 2973.3. Once I use my calculator to do that, it gives me shillings 1.06 per ordinary share. I'm getting shillings 1.06. Now from there we get to the other part of the question, whereby you are required to compute the diluted earnings per share. Now, to compute the diluted earnings per share, I will say basic EPS. We have just said that the diluted EPS is determined by adjusting the basic EPS. It is done by adjusting the basic EPS with the dilutive factors. Adjusting the basic EPS with the dilutive factors, or rather what we have just called potential ordinary shares. So diluted EPS, I have earnings, I have number of ordinary shares, and I have my EPS. I know that when I was computing my basic EPS, I had earnings of 3155. I had 2973 as my one-offs, 0.3, and the resultant EPS was 1.06. That was my resultant EPS. And since in this case I only have one dilutive factor, or rather a potential ordinary share in form of a loan stock. So my question is, what would happen to the earnings if the loan stock is converted into ordinary shares? Definitely, if the loan stock is converted into ordinary shares, the firm will cease to pay interest on the loan stock. And therefore, that would mean that the earnings would increase because the firm is no longer paying interest on the loan stock. But as I consider the increase in savings as a result of not paying interest, I must also consider the tax shield benefit. I must also consider the tax shield benefit as a result of interest. That interest was helping me to reduce my tax burden. It was helping me to reduce the tax burden. Therefore, as I consider the savings, I must consider the savings net of the tax effect. Therefore, my earnings would increase, incremental earnings, my earnings would increase by the interest. The rate of interest is 10%. So I write interest benefit, or if you want, interest savings. So I'm going to consider the rate of interest, which is 10% of 1,000. 10%, sorry, is it 10% or 8%? Sorry, it's an 8% loan stock. So 8% of 1,000, 8% of 1,000, multiplied by 1 minus tax rate. Tax rate is 30%, so I multiply it with 0.7. I multiply it with 0.7 because of the tax shield benefit. Therefore, my incremental earnings would be 8%, 8 divided by 100, times 1,000, times 0.7. This gives me interest saving net of tax of 56. So my earnings would increase by 56. Now, at the same time, supposing that the loan stock is converted into ordinary shares, that would mean that we will be having extraordinary shares. That would mean that the number of ordinary shares would increase. Therefore, my one-offs would change. And the one-offs will, of course, change with the increase in ordinary shares as a result of the conversion. Now, in this case, the rate of conversion, so I write incremental shares. Incremental shares. I write incremental shares. I write below that incremental shares. I know that the shares would change. The exchange ratio is, I have been told in the question that the 8% convertible loan stock can be converted at the option of the holders from the year 2022 at the rate of 125 ordinary shares for every 1,000 shillings. So the rate of conversion is 125 for every 1,000. And we know that the value of this loan stock is 1 million. So once I eliminate the thousands, it will still be 1,000. Therefore, it means the 1,000 and the 1,000 cancels out, and therefore my incremental shares would be 125. And therefore, my adjusted earnings would be 31.55 plus 56. This gives me 32.11. And my adjusted number of ordinary shares would be 2973.3 plus 125. This gives me 3098.3. 3098.3. And therefore, my diluted EPS would be 32.11, which is the new earnings, divided by new shares, which is 3098.3. This gives me 1.04. That is 1.036. Once I round it off to 2 decimal places, it will be 1.04. And therefore, you'll note that our diluted EPS has declined, has slightly declined as a result of the dilutive effects from 1.06 to 1.04. And therefore, generally, that is how you compute the basic EPS and diluted EPS. Therefore, I can leave you with some practice or one practice question. During your own time, I would like you to attempt a question from the past papers, from December 2017. I would like you to attempt a question from the past papers of December 2017 question 4B. During your own time, attempt DEC 2017 question 4B, where you are required to compute in part A the basic EPS, and in part B you are required to compute the diluted EPS. So until next time,